Millions of people can't afford their homes and they don't even realize why. They've been working, they're working a part-time job, they're trying to make ends meet and it never happens. They're going into debt more than ever before. Rising costs are strangling people like they've never seen, and yet they don't know why. Well, in this video, we are going to talk about the reasons why, look at some areas that are super expensive, others that are more affordable, and then at the end, I want to show you what Warren Buffett has warned about. All of that and more. Let's begin by taking a look at the PCE. What is that? Personal consumption expenditure. This is the Federal Reserve's way of looking at inflation. Of course, there's more realistic ones, but I found this chart interesting because it's the year-over-year headline inflation of supply and demand-driven PCE components. And the orange area is supply driven. Then we have the gray, which is ambiguous. And then there's the demand driven inflation. So the assumption here is that the supply driven inflation will eventually dissipate because all of the problems that we've seen since 2020 would go away mostly. That's what we're being told. So inflation, that part of the inflation would go away. But here we are. We're in 2023 and that still hasn't subsided. Even though, if you look at it realistically, are there still ships waiting on LA Long Beach port? Nope. Are there the same problems with not having the workers because they're all sick and they're all at home and they're all too worried to come into work? No, that's not happening. What in the world is going on today that we haven't seen before? Well, certainly there's a lot of money that's been sloshing around the financial system, and nobody wants to note how important that really is. Like, we're looking at that in, you and I would, but it seems like the economists are continuously ignoring it because, it's done with the Fed, and then they buy the debt of the US, or they buy the mortgage-backed securities, and it's up there, it's over there in that corner. There's so much more to that. Let's look at the real estate component though. I want to touch on this. This is important, okay? The US cities drowning in debt. US cities with the highest municipal debts per taxpayer. You could see it at the top of the list, New York City. Beyond that, Chicago, Honolulu, Portland, New Orleans, Philadelphia, and so on. So they're just showing you the change, what has happened. But I wanted to highlight this because it's not just individuals that have found themselves in more debt and things are unaffordable. It's the cities, it's the countries, it's the corporations. More debt. More money's been printed, more stimulus coming from the government. Is there a correlation with the fact that more debt has been created? Of course, because debt is now money. That's what they did. They made this system debt in 1971. That's important. Let's look at the next aspect. It is affordability is top of mind. This is talking about real estate and real estate agents and analysts and what they look at with the consumer in mind, okay? Affordability is top of mind, but so is the economy as a whole. Buyers are concerned about a recession, job loss, and inflation. I think the biggest concern is buying into a market that would continue to go down. In my 18-year career, I have never seen rates move like we are seeing now. What happened here? You saw rates go straight up to 7% and change in the United States. Other countries around the world, same thing, they were going straight up. Then they came down to just under 6%, and now they've moved back up again. Why did they move up? The expectation here is that the Federal Reserve, this is what was understood, the Federal Reserve is increasing rates. They're going to stop doing that. Inflation is coming down. It's all supply driven, but inflation will come down. Don't worry about that. And in 2023, we're going to see rate cuts. But here we are almost in March of 2023, and it doesn't look like rate cuts are anywhere on the horizon based on the Federal Reserve meeting minutes and other Fed members saying things in different interviews and speeches and so on. So that's why these rates are reacting. The bond market is reacting to that, and it has a direct impact on the consumer and on real estate. So it increases the level of unaffordability. People can't buy it. Whatever that is, if it's real estate in this case, or it might be some other big ticket item, a car and so on. So I hope I made myself clear. I'm trying to, by the way, trying to bring like the takeaway of exactly what I'm saying. If you appreciate that, please let me know. There's an interesting list here that you could see for yourself on Study Finds website. The top 5 small towns in America, according to quote unquote experts. The number 1 was Sedona, Arizona. Now there's different reasons, and you could see they always come up with these studies and so on that say based on the healthcare, based on the the cost of living and all these different things. But I just wanted to bring that to you. You've got areas in Colorado, looking at Vermont, Montana, South Carolina, and so on, okay? Just wanted to highlight that there are places that are much more affordable, generally smaller cities, smaller towns, that are beneficial. You got to find work. That's usually the issue when you move into there. And what you want, of course, is safety and security. A lot of these big cities have become rotten, and there's so much crime of all kinds, and it's not policed anymore. They can't do it. They can't keep up with it. And so this is the problem that we found ourselves in today. Prices have gone up. People with money, a lot of times they're just leaving. They're saying, well, I'm not dealing with this anymore. And so that's left a big burden on people that can't pay the bills. So you see what's happening. The debt rises as people with wealth are moving out. Maybe they're going to Florida. Maybe they're going to other places around the world, and they're saying, I'm not doing it anymore. So we have this as an issue, okay? It's all connected. I assure you, there's a method to the madness here. In less than a decade, you won't be able to afford a home in these cities. Long list right here out of Go Banking Rates. But here you can see Roseburg, Oregon, and just as an example, like I just want to show you this. There's Alabama's in here, Knoxville, Tennessee. Let's use this as an example, okay? 2022 home value is $299,000. 1 year projected growth rate is 23%. Who knows what it'll be, okay? You could see when it will become too expensive. In the year 2024, projected home value of $453,000 go down. 2032 projected home value, $2.4 million. Is it realistic? Well, you look back 10 years ago, what was it? Well, a lot of these places 10 years ago were so much cheaper. You thought 10 years ago, if you look at some of these prices, and you would have said what they are today, you would have said, absolutely not, no way, not going to happen. But anyway, the point here is some areas are seeing such a surge, and part of that is speculation. We know this. But another part is where the jobs are moving to. Where are the people moving in? So you might say, you've got this main city that's too busy, too expensive, the crime is up, whatever. But like an hour away in this direction, or maybe an hour and a half, maybe 2 hours, you've got these other smaller kind of cities that are nice and livable and so on. And those places people have moved into, and there might be some jobs there. And it might be something that people could travel to if necessary to get back to the main city. So these are the places where I believe you want to invest as an investor. You may want to live there too, because maybe you got family in the big city, but maybe you could move out to these other places. A lot of people did that in 2020, and there are still opportunities there. And I think if you look at the different ratios as an investor, for instance, how many dollars of rent you can get for how many dollars you invested into the property, a lot of these places are much, much better. Much better. So that's just one thing. I talked about that in my first book. Anyway, let's look at the next aspect here, which is part of that being inflation. You could see the US inflation rates rise over the last year. Different ways, as I said, to measure inflation, but this is just showing us that we are well off the peak, 9.1%. The CPI had come down, and we see it at 6.4%. That's slowing down, by the way. We'll see if that is the case coming in the next few months. The PCE price index measure of inflation whether we look at this or not, we are still really elevated. And truthfully, you can't bring down this level of inflation anytime soon meaningfully with these levels of interest rates. Okay, it needs to be above that level of the inflation, or else it's not going to come down fast. It's going to take a long, long time. And what does that mean? That means that real estate prices can actually remain elevated for a long period of time if those rates aren't there chopping down at it. So keep that in mind. It's not as if, oh, rates increase, housing collapse. No, it's not how it works. We have to watch that. Places that use a lot of variable, that's a different story. That hits them harder sooner. Australia, Canada, and other places. If you, by the way, if you are living in a place that uses a lot of variable interest rates in your country, please post it below. Let me know where those are. I will be commenting in reply to you, okay? You have US consumer price inflation from 1981 to 2023, and you can see we are at the levels that we experienced back during that time. Not so much, but it depends. If you're looking at, for instance, college tuition, college textbooks, all these things, healthcare, it's actually beyond. It's beyond what was experienced. Inflation is ridiculous today in these ways. Now, we had Berkshire Hathaway, Warren Buffett, fourth quarter operating earnings fall 8%, cash hoard swells to nearly $130 billion. That's one aspect. Number one, why is this guy keeping $130 billion at the side when he should be buying stuff, right? If you thought that he saw value, he would be buying stuff. But maybe that's not the case, is it? Well, there was something else he said. Billionaire investment guru Warren Buffett issues stark inflation warning that fiscal deficits have consequences after rate rose to 5.4% and Wall Street saw its worst week of 2023. All right. He said the downturn wouldn't last. He urged investors to watch out for businesses that would try to deceive them with rosy earnings reports. Most people do not read the earnings reports, so you don't have to worry about that because people won't even know. Okay? But it's important because he warned about that. Fiscal deficits have consequences, but we're told that they don't. We're told that the debt is manageable. I brought that up at the beginning of the video. It's important. What about this? The global cost to decarbonize power grids could amount to more than $28 trillion. And the second sentence is, that's a big deal for one company that could bring countless consumers toward an all-electric life. You got to look at which companies do that, and of course, they will benefit. The government, part of this article was basically just suggesting that the government's giving incentives for energy efficiency, the government's giving incentives for electric vehicles, all these things. There is money. You got to realize this. People, they can't afford their homes. People, they can't, they're spending countless dollars just on the interest on their home, on their credit card, personal loans, and so on. And yet, there's trillions of dollars still being thrown out there. The countries, the cities, the corporations, the people will all get into more debt. That's inevitable. We know this. But there's money still being deployed in different places. And that's where you have to look. It's going to have fluctuations. We're going to see problems. But this is what's happening. When I told people, look at uranium, it's looking really interesting. There was a reason for that. And now we see today. Because these governments have to start saying, well, you know what? We need nuclear power. And they're going to label this green everywhere. And that's going to create a huge influx of demand for uranium. That's just one thing. And so I show you this. And we see that, how it's all connected. Watch out. Debt is very concerning. Do not get into high interest rate debt if you, at all possible. People say, oh, it's just temporary. And then it ends up being something that sticks with them for a long time until they claim bankruptcy. So we got to try to avoid that if at all possible. And don't do what the country does. Okay? I think it's so important to see that. If you found this video informative and the takeaways that I try to give you now that I'm going to make a point of, even if that means the video has to be a little bit longer, that the takeaways are there. Please let me know in the comments below. I really appreciate you being here, especially to the end of the video. Thank you very much. And don't forget to check me out tomorrow, The Money GPS. I'll see you then. Take care.